Market volatility has picked up of late as investors assess the outlook for global growth, inflation, and monetary policy. The S&P 500 index has lost its gains from the May lows as the 10-year Treasury yield has moved from 2.95% to over 3.3%. As inflation stays stubbornly high, we are more cautious on U.S. economic growth. Let's take a closer look. Central bank policy is frequently described as working with a lag, but we think this understates its impact. Financial conditions have tightened much more than average over what has occurred in the prior 5 rate cycles. We've also seen the savings rate of the U.S. consumer fall to just 4.4%, as wage growth of 5.2% has been swamped by consumer price increases of 8.6%. This drawdown in savings is expected to limit growth in consumer spending over the next year, as will financial market volatility. Under these conditions, we now expect modestly disappointing growth in the U.S. over the next year, joining our cautious outlook towards European and Chinese growth. Eventually, we expect slowing growth to start to reduce pressure on inflation globally over the next year. However, we see limited evidence of this so far, as May U.S. consumer prices exceeded estimates and European inflation of 8.1% was also above expectations. This underpins our risk case of sticky inflation, where stubbornly high inflation leads to more hawkish central bank policy. Our base case calls for slower growth globally, as inflation and higher interest rates join risks from Ukraine and the Chinese zero-COVID policy to hamper growth. We are also focused on central banks' management of inflation expectations. We made one change in our global policy model allocations this month in response to our more cautious outlook for U.S. growth. We reduced our recommended allocation to U.S. equities by 2%, reinvesting in the more defensive global listed infrastructure asset class. Equity markets have adjusted significantly to higher interest rates and the more uncertain growth outlook. Looking out over the next year, we favor real assets like natural resources and global listed infrastructure, which are benefiting from supply shortages and are an inflation hedge. We also continue to like high-yield bonds, where we think the current yield of 7.8% will prove attractive, as we think the market is overstating the odds of recession in 2023.